Welcome to Checks and Balances. I'm Michael Vincent. This is James Blair. And this week we've got Dean Anderson, CEO of Kernel. He's come on the podcast to tell us how you can perfectly time the stock market.
Okay, how to perfectly time the stock market. Is it buy high, sell low, or sell low, buy high, Dean? What's the right strategy?
At the moment, it seems to do nothing. Everybody's sitting on their hands, right?
Yeah. So since this is the worst first 6 months in the stock market since the 1970s. So the share market's down about 20% year to date. There are a lot, and Dean, maybe you can talk about transaction numbers as well, a little bit as well, in terms of how people are feeling out there and what's going on. But there's a lot of people maybe sitting on cash. Mike, same thing in the property market going, I'm going to wait for it to drop a little bit more. We're now in a recession. There's periods of uncertainty. So what we like in periods like right now is actual facts and stats, which we can look at historically what will happen going forward. So Dean, you've got a little bit of research to talk us through. What are the parameters of the research?
Well, the whole point was that a lot of people coming to us going, okay, when should I invest and how do I time the market? You know, equally 6 months ago when the markets were at their highs, should I be investing now? Now, should I invest? It's at a discount. Why would you not? And so what we want to do is look back and go, you've got some disposable income. You've got $100 a week. What are you going to do with it? You've got a few options, right? You could sit in the bank, earn some interest, or you could invest it. And what we tried to look at was what's the best strategy to maximize your money? How do you invest that $100? And what are the outcomes of it? And so we went back and did a study over the last 22 years and basically ran all the numbers to go, okay, if you regularly invest $100 a week into the market, what happens? Or if you sat on that money and then tried to time the market, how much better off you would have been?
So the year is 1999, and you are about to start saving $100 a week to secure your financial future. Now, what do you do with that money? So the interesting thing before we talk about the results over 22 years is in terms of what's happened over the markets over that period, there's been 7 corrections, a couple very notable ones. But Dean, there's been 7 times where the markets have dropped by 10% or more.
Yeah.
So you go, whoa, if you can time
20% or more. 20%, yeah.
Wow.
Corrections,
okay. Yeah. So if you can time that period where it's dropped significantly, surely, Dean, surely you're going to be substantially better off than just strip feeding. You just wait for the low and buy low, sell high, right?
Exactly. And just on those 7 days only. Yeah. So 22 years and you find those 7 days. So it's easy. And so, yeah, exactly. We ran the numbers and had a look at it. I think the big thing here is to look back and go, remember actually what has happened over 22 years. You've had .com bust, you've had 9/11, you've had the GFC, we've had COVID, all of these major events. And reality is the best thing you could have done was just simply start investing, like honestly putting away that money and being an investor and building wealth over time is still the best outcome overall.
So if we look through the numbers, if just the savings over 22 years is a little bit over $110,000 that you will have accumulated, which as a starting point, like you're pretty happy with that if you've actually managed to save some money, because that's better than most. So if you put that into a savings account and just made like a little bit of a return, that's a little bit over $150,000. So you've made somewhere around $40,000 in returns. Yeah. Should we start with the worst or the best?
Yeah, so we looked at a few things as well. Like we wanted to go, okay, what happens if you absolutely stuffed it up and invested on the peaks every time there was a peak, right? And even then, if you invested only at the peaks and then held your investments, you still end up with, $250,000, right? So you've still effectively doubled your money over that 20 years, even if you put it in on the absolute worst days.
And if we bring it back to today, that's what people are worried about right now, that they're about to, we're not at a peak, we're obviously down from the peak, but people are worried that there's more to go, there's uncertainty. Interesting, and Mike, same with the property market. When the market was rising up, everybody wanted to invest last year, but now people are worried again.
It's an interesting one, right? And we have this discussion across the board, whether it's property, equities, whatever, with your investments, is when things are going well, everyone's like, I don't want to be the guy that invested at the peak. I'm going to sit and not do anything and wait a bit. When we have the same conversations, I've said it 100 times, when things are on the way down, like, I don't want to overpay, it'll drop a little bit more. When is this Goldilocks moment that you're going to invest? It simply doesn't exist. And you can clearly see here, even being in on the worst day, you're still doing all right.
Because I think one of the things with that, even if you pick the worst day to invest, in 10, 20 years time, which, we fundamentally believe in long-term investing, it's going to be a great time in the future. It just sucks in the moment.
Yeah, correct.
So if you pick the worst time, so if you just invest into a savings account, 150,000 over the 22 years, 250,000 if it's the worst timing. Dean, if we have the best timing, if we pick the 7 kind of best days to invest, where do we end up?
About $340,000, $333,000 actually. So again, good results, but a bit different than just picking the worst days or investing on that peak. But obviously over time, you've basically tripled your money.
Yep. Okay. And then the other one, which is what we fundamentally believe in. So our purpose at Lighthouse, securing your financial future. We believe education plus action equals freedom. The action piece. The action is slept on, just regularly investing, just putting that $100 in a week regularly over time. So 350 odd that
330,000 basically.
Yeah, if you end up at the best time. If you just regularly drip feed, where do you end up?
310,000.
Okay.
So over 22 years, a 7% difference. Now, just think about those two scenarios though. The scenario of $330,000 involved somebody putting all their time and energy, constantly stressing about the markets, reading headlines, trying to save up their money and pick 7 days over 22 years when to invest. Impossible, not going to happen. The guy that simply put $100 away, set up an auto investment plan and forgot about it, ended up basically, you could call it the same result.
Yeah.
So you can't time the market.
Yeah, and it's putting the timing the market a bit aside as well, which is just, it's simply impossible to be that guy. Yeah. There are professionals who spend all day writing algorithms, researching companies, researching the market, who still get it completely wrong. Is when we come back to the taking action bit, like the dollar cost averaging, the regular investment piece, when we give financial advice, James and I know this really well, is that people want that to be the taking action bit. That is not the taking action bit. Don't get me wrong, it's the start of the journey, but you then actually have to implement the strategy. And that is the hardest bit that we actually get. In theory, it's really nice for me to tell people, if you get an investment property now and hold it for 10 years and you might double in value, X, Y, Z, people think, great, perfect. And then we go, do you want to take the plunge? And they go, oh, I might just wait a bit longer. The market might come down a bit. It's very difficult to get people to actually take action.
And I think a really good learning there as well, Mike, is if you have short-term goals, if you are looking to buy a house in 6 months, if you're looking to use the money in the short term, if you invest in the worst day, it's going to hurt a lot. But if you have a good financial plan, which is based off long-term outcomes, we're thinking about providing you with an income for early retirement, kind of a 10-year sort of time frame, just get the money to work. Just get the money to work. The facts are there. Dean, it speaks for itself, right?
It does. And unfortunately, it's not sexy. It's actually, it's the simple, unsexy, it's regularly investing into a well-diversified portfolio and actually turning off your phone.
Yeah.
Don't look at it. You don't have to do anything.
$100 a week does not sound as sexy as perfectly timing the market, right?
Yeah. The human psyche is a fascinating thing. You go, not sexy, and people go, well, that shouldn't come into the decision making. It 100% comes into the decision making. And part of a financial plan in my job as well is going, that's a stupid idea. Definitely do not do that thing you're thinking about doing. But people like to do something because to make them feel like they're getting ahead.
And the thing with it, I think, to your point, is the action stuff, right? It's starting small and setting it up and letting it do its thing. For those first few years, it'll actually feel like not much is happening, right? It slowly, incrementally builds up. But then you'll really start, a few years in, when the balance starts building, you'll really start to see the momentum coming behind it. And the one thing is getting to that behavioral, good behavior set up of just regularly doing it, habitual, and forget about it. Yeah. Don't look at it. Don't stress about it. It's actually a great way to live. Like, who wants to be worrying about what's happening in the stock market every day?
Small, consistent steps over time builds wealth. It's like a snowball rolling down the hill, building momentum as we go.
Warren Buffett talked about the exact same thing of his building wealth over time. It's the exact same outcome. Like, he has just been a continual investor, and he basically realized that, and talks about the fact that the energy that it would take for him to perfectly time some of these things over the long run, it's just the cost and the time of doing it is just not possible.
Yeah. The other thing is, if you look at the drops over time, after more time, it doesn't look nearly as bad, does it?
No, and I would reinforce here the one key piece with all of this. Remember, it is a well-diversified portfolio. This isn't about speculating on single stock or anything like that. It's just a good, simple, vanilla, well-diversified portfolio and time.
Yep. Okay. Well, Dean, thank you very much for joining us. Thank you for bringing the stats, bringing the facts. Speaking of stats and facts, a fact is you should like this video, you should subscribe, and you should give us a review. We will see you next week.
Cheers.